Donald Trump delivering on his tariff threat. The stock market is selling off. We saw it overseas and now playing out in this first hour of trading in North America. For some more insight, we're joined by James Callahan. He's a portfolio manager at Barometer Capital Management. James, nice to see you.
Thank you, John.
Was the market too complacent when it came to tariffs and the threat of them, do you think?
I think market was a bit complacent on the threat of tariffs, but when you look at market internals over the last 2 weeks, yes, the price action yesterday and today is painful and severe, but it's not really surprising. We've seen significant deterioration in market internals over the last 2 weeks. We've seen some of the darling momentum stocks sell off really sharply, and the largest US stocks really underperform and start to break down on a technical basis. So we don't think it's surprising given reading the tea leaves out of the U.S. administration, what their goals likely are here.
Okay, and tech is down today, including in Canada. I mean, if you had to guess how much of this might be an excuse for investors to sell during a bull market versus people having to try to figure out what's next for the world and for profitability if we're talking about real economic risks here.
Absolutely. There are some great profits to be taken off the table here, and I think that's what we've seen so far. You know, our view has gotten significantly more cautious over the last 2 weeks because the amount of economic uncertainty, I've never seen anything like it. When you look at economic uncertainty, policy uncertainty indices, like they're at all-time highs. There are just a lot of open questions right now, and it can be tough to parse where we're going to go from here.
And so when you're making investment decisions right now, I would argue a lot of them are made with sort of a long-term thinking, but have you been thinking about trying to do some positioning around companies that might be, I don't know, like tariff immune?
So we have. There are some names that we can talk about that are probably less levered to tariff impacts, like some of the aircraft producers and aircraft parts manufacturers. Some names that are outside of the U.S. and Canada that are still performing well. The concern, of course, is that, you know, when we see these types of declines, correlations can tend to go to one in the U.S. market and in the Canadian market as well, which is why we've looked globally for some opportunities. But I do have to stress, like we've raised a significant amount of cash in our portfolios just to hedge some market volatility here.
Okay, so like let's say, you know, you're an average investor and you're putting some money to work in stocks, maybe something in bonds, and then you're always thinking, what's the cash component? What would be the cash component that you guys have been putting on the sidelines right now?
So right now we sit around 20% in our portfolios. That likely comes a little bit higher after price action today. We do have some gold names as well. We do have some bonds where it makes sense to have them. But the outlook going forward, like our view really has turned into, it's likely the easy money's been made at this point. And so from an index perspective, we likely see some weakness persist because market internals are quite weak. But it's possible that it turns into a stock picker's market. There are some good opportunities to be had, but it's going to take some time for us to work through this weakness that we've seen right now, because out of the Trump administration in the US, maybe we can spend some time on this. Their goal increasingly has been to condition investors for economic weakness. We started to see it over the weekend when the Treasury Secretary Scott Bessent gave an interview, and he claimed it's not Trump's economy until 6 or 12 months post-inauguration. It's still Biden's economy in their mind right now. We also saw Elon Musk on Twitter over the weekend ask the question, how appropriate is it to measure the productivity of a country through GDP, which includes a large component of government spending? I think that's a fair question to ask, especially given the type of austerity programs that we've seen in the US right now. It's like nothing we've ever seen, maybe in Argentina a few years ago only. So they're conditioning investors for weak economic numbers, and I think that's what we're seeing play out in markets over the course of the last few days.
Well, I think what's tough about knowing how it all ends, based on what you're saying, is that how the president himself feels about frustration if the stock market is going down, if a tariff war leads to inflationary fears for average consumers, if it possibly leads to job losses in the U.S., as it might lead to job losses here in Canada as well. At what point is there a frustration felt that forces a change in direction just based on what the polling numbers are telling him? And I guess nobody knows the answer to that.
No, but I will tell you what I think their goal is. I think their goal is to take yields down in the U.S. We've seen members of the administration talk about how the metric by which they should be judged this term is not the equity markets, it should be the bond markets. And so what that tells us is that they're looking for the Federal Reserve to see this economic uncertainty coming and maybe economic weakness, like when we see potential weak GDP numbers. We saw the Atlanta Federal Reserve GDP now number come down over the course of a month from expectations of 4% GDP growth to expectations of negative 3% GDP growth. We think it's likely that the administration is trying to push on the bond market in order to refinance the $9 trillion of US federal debt that comes due this year. That's going to be a big step that they want to take towards reducing the deficit. I'm not one that thinks they're playing 3D chess or anything like that, but I do think that it's one of the only things that makes sense to me when you look at the actions they've taken over the last little while. And if you ask me, try to tank the economy, and I was king for a day, that's what I would do. I would increase economic and policy uncertainty. I would slash government spending. It's that seems like it's the case.
Well, whether it's geopolitics or the economy, push one door and you never know what's going to come out the other door. So we'll see how they navigate that. Real quickly, we're out of time, but you teased that you thought of some, I guess they were aerospace names.
Yeah, absolutely.
That might be less immune. Just real quickly.
So a name that's worked really well for us over the last kind of year that we've owned it is Embraer. So they're starting to fill the gap that's left by Boeing in the aircraft market as they've had production issues. So Embraer is the leader in regional sized jets, kind of under 150 seats. And we've seen a number of large deals signed as aircraft owners and operators are seeking to buy airplanes, and it's a supply constrained market. So they're looking increasingly to Embraer to do that.
Okay. James, thanks very much. Appreciate it.
Thanks, John.
James Callahan is a portfolio manager at Barometer Capital.